Over 90% of cryptocurrencies launched since 2017 have failed, become effectively worthless, or are now considered dead projects. That's a staggering figure, highlighting an ocean of speculation where only a select few genuine innovations survive. The market is saturated with projects promising revolution but delivering only vaporware, leaving countless investors with devastating losses. By the end of this video, you'll possess a robust, 5-pillar framework to meticulously evaluate any cryptocurrency, separating the truly transformative from the dangerously deceptive. You'll learn precisely how to analyze a project's team, technology, community, economics, and inherent risks, empowering you to make informed, data-driven investment decisions in this volatile asset class. Our first pillar for evaluation is the team and vision. Who stands behind this project, and what problem are they genuinely trying to solve? A strong team isn't just about technical prowess, it's about transparency, a proven track record, and a clear, compelling white paper that outlines a real-world utility, not just a theoretical concept. Look for public figures, previous successes, and clear communication channels. For instance, Ethereum's enduring success is partly attributed to Vitalik Buterin's transparent leadership and persistent vision, starkly contrasting with the anonymous teams behind many short-lived meme coins whose only purpose is hype. A well-defined problem statement and a credible solution are paramount. Does the project aim to revolutionize supply chains, enhance digital identity, or simply create another digital collectible? A project like Chainlink, for example, addresses the critical problem of connecting real-world data to smart contracts, providing a tangible service essential for decentralized applications. Without a clear, valuable use case, even the most brilliant technology is just a solution in search of a problem. But a great team and a clear vision alone aren't enough. You need to look under the hood at the technology and use case itself. This is where you assess the fundamental innovation. How does the blockchain operate? What are its core functionalities, and how does it compare to existing solutions? Consider the blockchain trilemma of scalability, security, and decentralization. Every project makes trade-offs. Examine key metrics like transaction per second, TPS, transaction fees, and finality. Bitcoin processes around 7 TPS, Ethereum 15 to 30 TPS, while newer networks like Solana claim tens of thousands, albeit with different decentralization compromises. If a project aims to facilitate global payments, its transaction speed and cost must be competitive with traditional systems, or offer a significant advantage. A crypto designed for micropayments, for example, would fail if its fees consistently exceeded the payment itself. Even groundbreaking technology can fall flat without a vibrant community and development activity. This third pillar gauges the health and longevity of the project's ecosystem. A strong community drives adoption, provides feedback, and contributes to the network's resilience. Look at GitHub repositories. Are there consistent code commits, multiple contributors, and active discussions? Projects with dormant GitHubs for months are often on life support, regardless of their initial promises. Beyond code, assess social media engagement, but critically, differentiate genuine discussion from pure hype. Are there active forums, developer grants, and educational initiatives? Cardano, for instance, has cultivated a highly engaged academic and developer community, consistently pushing updates and research. A project with hundreds of thousands of followers but minimal meaningful interaction or actual product usage suggests a superficial appeal that won't sustain long-term growth. Don't be fooled by hype. The market structure itself reveals crucial truths, leading us to the fourth pillar, tokenomics and market dynamics. This is the economic blueprint of the cryptocurrency. How is the token distributed? What is its supply schedule? Is it inflationary or deflationary? What is its utility within the ecosystem? A token designed simply for speculation, without a clear role in governance, staking, or paying for network services, has limited intrinsic value. Analyze the initial distribution. Was it fair, or did a small group of founders and early investors receive a disproportionate share, potentially leading to future sell-offs? Understand the vesting schedules for team and private investor tokens. If billions of tokens unlock simultaneously, it could trigger massive price depreciation. Compare the circulating supply to the total supply and fully diluted valuation. A project with a low circulating supply but a massive future unlock schedule might appear cheap, but its future market cap could be significantly higher, meaning less room for growth. For example, Bitcoin's fixed supply of 21 million tokens, with predictable halvings, creates scarcity, a fundamental driver of its value. Finally, and perhaps most critically, you must understand the regulatory landscape and risks. The crypto space operates in a legal gray area in many jurisdictions, and regulatory crackdowns or clarity can profoundly impact a project's viability. Is the project's token likely to be classified as a security by bodies like the SEC? Ripple's ongoing legal battle with the SEC highlights the existential threat regulatory uncertainty poses. Furthermore, assess the inherent technological and security risks. Has the smart contract code been audited by reputable third parties? Are there known vulnerabilities? The DAO hack in 2016, which exploited a vulnerability in Ethereum's smart contracts, resulted in millions of dollars lost and ultimately led to a hard fork of the entire network. Beyond code, consider centralization risks. If a few entities control a majority of the network's nodes or staking power, it undermines the very ethos of decentralization and creates single points of failure. Ultimately, evaluating cryptocurrency isn't about chasing the next 100x gem. It's about disciplined risk management and understanding intrinsic value beyond speculative hype. By systematically assessing a project's team, technology, community, tokenomics, and regulatory exposure, you transform speculation into informed investment, navigating the digital frontier with a clear map rather than blind hope. Next, discover the common pitfalls even experienced crypto investors make, and how to avoid them. Until then, remember, in the world of digital assets, knowledge isn't just power, it's your ultimate safeguard.